Okay. Hello, I am Raimundo Undurraga. I am Assistant Professor of Economics at the University of Chile. And today I will present a paper on gender discrimination in consumer credit markets. This is a joint work with María Montoya, Eric Parrado, and Alexander Solis. So we thank the NBER Summer Institute, Gender in the Economic Group for this invitation. Okay, if we look at the gender gap in access to credit markets, we will see that this is large and systematic, especially in the context of developing countries. A natural explanation is the wage gap between men and women. Indeed, the lower wages earned by women make them riskier for banks, which limit their capacity to obtain loans. Alternatively, gender differences may be driven by discrimination against women, either statistical or taste-based. And that would be the case, for example, if, let's say, two identical loan requests are treated differently by virtue of the applicant's gender, but gender by itself has no direct effect on the profits associated to the loan request. So the question here is how much of the gender gap in access to credits is explained by discrimination against female borrowers? The question is important not only because of normative implications, but also because it can affect efficiency and thus welfare. For instance, a well-known result in economic theory is that taste-based discrimination generate inefficiency in the allocation of resources in the credit market. Since in that case, the approval decision of a loan request is based on the attributes that are not related to the profitability of the loan request, but on other things, for example, the gender of the individual. On the other side, statistical discrimination is efficient if this is an optimal response to an asymmetric information problem between the beliefs of the loan officers about the credit risk of the borrowers on the one side and the actual risk profile of those borrowers on the other side. But note that statistical discrimination will be efficient only if the beliefs of the loan officers are accurate beliefs. That is, these follow rational expectations and are not related to gender preferences, which may or may not be the case in reality. So those are the reasons of why it's important to study gender discrimination in credit markets. Now, identifying gender discrimination in credit markets is not an easy task. You may imagine that there are full of unobservables here. They are everywhere, and we need a lot of data at the level of applicants, officers, loans, and banks. For instance, if we sign an NDA with a bank in order to access to key data, we will probably have no problems to get data about the bank, data about the loan characteristics that were requested by the clients, as well as the characteristic of the clients, like, for example, demographics, income, debt, collaterals, and credit history, which is typically what the banks require to evaluate a loan request. And of course, all this kind of data is quite useful as a starting point, but we're far from being in the ideal world. Indeed, we will usually do not observe all the characteristics affecting the decision-making process of the loan officers, who have a lot of influence in the final outcome. If we are lucky, at the most we can observe, for example, basic demographic characteristics like age, education, and experience of loan officers, but traits like gender preferences, gender beliefs are typically unobservable. And given that these non-observables are simultaneously correlated with both the applicant gender on the one side and on the probability of approval on the other side, then we will have a serious selection problem. Now, the natural solution for this selection problem is to implement an audit study, pretty much like in papers in labor economics, where people want to identify discrimination in accessing jobs by sending false CVs, where the name, the gender, or the race of the individual is randomly manipulated. Here we could think on randomly manipulate the gender attached to the loan request. However, this is quite unfeasible in credit markets since platforms like Experian, TransUnion, or Equifax typically allows the banks to easily identify false loan requests by just looking at your tax identifying number, which is an attribute that you have to provide in order for the banks to initiate a process of loan evaluation. So what's the solution that we implement in this paper? Basically, what we do is to implement a randomized correspondence study but with male and female real borrowers, where you don't have to randomize gender, but just randomly assign loan requests and loan officers to each borrower. So we will implement this correspondence study in consumer credit markets in the context of Chile. We will recruit a number of male and female potential borrowers with similar characteristics who are willing to participate in this experiment. And then we will randomly assign them different types of loan requests with random amount and random length. And then we'll ask them to submit the assigned loan request to randomly assigned loan officers operating in Chilean banks. So what's going to be novel in this paper? First of all, in our setting, officers will evaluate experimental applications sent by real applicants in real time. So this is something that has not been done before, at least in the discrimination literature in credit markets. Second, our sample of loan officers will work in banks that represent more than 95% of the consumer credit transactions, so that we can causally estimate, for example, what are the efficiency costs at the industry level associated with gender discrimination. Third, we have a battery of subjective measures and experimental tests that will allow us to elicit the gender preferences of loan officers. And those, for example, test for the presence of taste-based discrimination, which is a critical mechanism that may be explaining gender discrimination. Finally, something that is interesting of the Chilean context is that here women have better repayment rates than men. So one hypothesis is that gender gaps against women is produced because of inaccurate beliefs about the repayment capacity of female borrowers. So we will examine this hypothesis through an information experiment where some loan officers will randomly be informed about the better repayment rate of women relative to men, and some others will not. So the experiment will be helpful to disentangle the potential role of inaccurate statistical discrimination on the gender gaps in credit access. So what are the key findings we obtained from this experiment? First of all, we find that there is gender discrimination against female borrowers. On average, we find that the women are 18% less likely to get approved loans compared to men. This is a large effect. We estimate that the foregone profits associated with this gender discrimination is on the order of $6 million a year, which is equivalent to the annual cost of hiring 4% of the loan officers' labor force. Second, we will find that gender discrimination comes mostly from male officers who have stated preferences for male clients, suggesting taste-based discrimination. We will also find that the information treatment didn't reduce gender discrimination, which allows us to discard inaccurate statistical discrimination as an hypothesis. Now, when we disaggregate the treatment effect by gender preferences of loan officers, we will find that pro-male officers counter-reacted to the information treatment, and indeed end up discriminating more against women, not less. And this result will reinforce the taste-based mechanism. Now, of course, this is an unexpected result, and we will argue that a potential explanation is overconfidence bias on the part of pro-male officers. Finally, we will also find some evidence that competition reduces gender discrimination. So let me now explain you a little bit how this experiment works in practice, and then we can discuss the results. So we first recruited roughly 400 potential borrowers willing to participate in a consumer lending experiment, each of which was incentivized with $15 for their participation. So these are young men and young women between 25 and 35 years old with very limited experience in the credit market. And importantly, these are men and women that had similar characteristics in terms of the attributes typically required by banks to evaluate a loan request, like, for example, demographics, income, debt, collaterals, and credit history. So we then created roughly 1,600 loan requests of random amount and random length, and randomly assigned 4 loan requests to each participant. The loan amounts were between $1,000 and $14,000, and the loan length was around between 12 and 60 months. Finally, the participant had to send the 4 loan requests via email to 4 different loan officers that were randomly assigned. So our sample of loan officers actually come from a representative survey conducted jointly with the National Authority of Banking Regulation, the SBIF, we surveyed around 2,000 loan officers and randomly selected roughly 600 of them for the experiment. For the information experiment, half of the loan officers were randomly assigned the treatment message at the end of the survey, and half of the other ones were not assigned that message. So in total, we have around 1,600 loan applications that were randomly allocated to around 600 loan officers for an average of 3 loan applications per loan officer. So just to have an idea of how this operated in practice, this is an example of a loan request. So it says, for example, dear Mr. or Miss X, I am quoting loan conditions. I got your email. I would like to obtain a personal loan in the amount of 5 million Chilean pesos. I want to repay in 24 months. This is my tax identifying number. This is my monthly salary. See attached my wage settlements and social security contribution. So note that the applicants here were not allowed to negotiate the credit conditions with the loan officers, so that we take control of the negotiation capacity of male and female borrowers, which may well be heterogeneous across gender. So they just asked for a yes/no response on the part of loan officers. Now, in case officers required additional information, then the applicants were mandated to just provide the required information and wait until the final decision. So now let's discuss a little bit the results. Okay, we have 2 outcomes of interest here. One is whether the loan request was responded by the loan officer or not, and the other one is whether the loan request was approved by the loan officer or not. So these are extensive margin outcomes. We also discuss intensive margin effects in the paper, like effects on the interest rate offered or the amount approved. But of course, all those effects are not causal effects because they are conditional on whether the loan was approved or not. And that approval rate, as we will see later, is going to diverge across male and female applications. So we estimate a linear probability model of each outcome against a female dummy. And we will control for a number of covariates, including officer gender, bank fixed effects, loan amount, loan term, time fixed effects, a set of income and demographic characteristics at the applicant level, and a set of demographic characteristics at the officer level. All of them that is information that was obtained from the baseline survey to loan officers. So the parameters of interest here is beta. A negative beta means that there is gender discrimination against women. And what we'll observe is, first of all, that in 86% of the cases, loan officers actually responded to borrowers. That means that they evaluated the loan request and informed the borrower if the application was accepted or rejected. Note that we find no evidence of gender discrimination against female borrowers in response rate. This is equal between applications submitted by men and women. However, on approval rate, the story is quite different. Here we find that the approval rate is 6.4 percentage points lower among female borrowers. So this amounts to around 18% of the approval rate among men. So we are talking about a large gender discrimination effect. Now, what are the mechanisms that may be driving the gender discrimination effects? So for a first glance, we ask loan officers to report the main problem they face when dealing with male and female clients. So we offered a list with 5 types of problems, like the clients have low repayment rates, they are uninformed about financial products, they imply excessive administrative duties, they are difficult to communicate, or they are too tough and require quick response. There is one problem with women that almost half of officers mention, which is the last one in this table, that female clients are too tough and require quick responses. So this is not a reason that we may associate to statistical discrimination, but more likely to taste-based discrimination. Now, of course, this is just descriptive evidence about beliefs and not necessarily implied taste-based discrimination. So a more rigorous way to identify taste-based discrimination is to elicit the gender preferences of loan officers, and that is precisely what we will do in the next step. Okay, so to do so, we asked the loan officers to report on the proportion of male and female clients that they would like to have in an optimal portfolio of clients. So while the majority of the loan officers reported neutral preferences, 28% of them prefer more male than female clients in their optimal portfolio. And we will call them pro-male officers. Okay. The question here is whether pro-male officers actually discriminate more against women or not. But wait, someone may prefer more male than female clients, not because they have any sort of animus against women, but just because they believe that financial products that are typically required by female clients are less profitable than those required by male clients. So to test whether pro-male preferences are actually driven by taste-based attributes, we will implement a gift experiment where, as a reward for participating in the survey, each loan officer will gain 2 tickets to participate in a real lottery that raffled 5 iPads. So the loan officers had the chance to use the 2 tickets or use one and donate the other ticket to a given colleague. And we will randomly assign different names of colleagues, half of which will be masculine names and the other half will be feminine names. So the idea here is to test whether pro-male officers actually donate less to female colleagues relative to their not pro-male counterparts. And as we see in this table, we will find that being pro-male is very much correlated with less donation to women colleagues, but this is mostly the case for male officers, as we see in the right panel of this table. So the question now is whether male officers who are pro-male discriminate more against female borrowers or not. Here we have a graph that summarizes the relationship between gender preferences and gender discrimination. And as we observe in the left panel, most of the effect comes from male officers who have pro-male gender preferences, suggesting that the bulk of the gender difference in access to credit markets is driven by taste-based discrimination. We further examine how the discrimination effects are distributed across banks. And we find that banks with a larger proportion of male officers in their staff headcounts are associated with larger level of discrimination against women. So this is a result that reinforces the fact that gender discrimination against female borrowers comes mostly from male officers. Okay, let's discuss now an alternative mechanism, which is inaccurate statistical discrimination. Something that is interesting in the Chilean context is that the women have better repayment rates than men. So one hypothesis is that gender discrimination is produced because of inaccurate beliefs on the part of loan officers. So we examine this hypothesis by implementing an information experiment where some loan officers were randomly informed about the better repayment rates of women relative to men, and some others were not. So the idea here is to test whether correcting the biased beliefs of officers can actually reduce gender discrimination against women. So the treatment message was posted at the end of the survey and say the following. Did you know that female borrowers pay more for consumer credit than males? A recent report released by SBIF shows that women pay interest rates that are, on average, 15% higher relative to those paid by men. This is even though the same report also shows that female borrowers exhibit repayment rates that are significantly higher compared to male borrowers. Gender discrimination against women may bring negative consequences for women who aim to access the consumer credit markets, as well as for our economy, as it might be inefficient and damaging for productivity. Here we have the treatment effects. If we take the full sample, we don't find any effect. However, when we disaggregate the results by gender preferences, we will find that treated officers, those who receive the message, who are pro-male, increase gender discrimination compared to the control counterparts, as we see in the bottom row. So of course, this result is quite unexpected, and one potential explanation is overconfidence bias, as suggested by Hajduk, Kuseji, and Strack in a recent paper. The story here is that pro-male loan officers have self-serving views about discrimination, so they will overestimate the degree of discrimination against any group whose preferences are aligned with, in this case, for example, male applicants, but will underestimate discrimination against any group they compete with or are not aligned with, like, for example, female applicants. So what happened here is that our information treatment goes against male borrowers. So when pro-male officers receive this treatment message, they underestimate the message because it went against a group whose preferences were aligned with, in this case, male borrowers. And indeed counter-reacted to the message and started to discriminate more against the opposite group, in this case, the female borrowers. Our results is not unique. Indeed, it is consistent with Bonnet 2016, who shows that explicit diversity programs in the US corporations have made between groups differences more salient, which in turn have generated more discrimination against minority groups and not less. And here again, of course, overconfidence bias on the part of discriminators arise as a potential explanation. We will finally examine the Becker's prediction that market competition decreased discrimination. We have data on the number of local offices that banks have in each municipality. So we can calculate the HH index on market concentration for each municipality, and then just test how gender discrimination behaves across different levels of market concentration. And indeed, what we will find is that market concentration increases gender discrimination, and this is mostly the case of loan requests submitted to pro-male officers, those who are biased against female borrowers. So this is a result that is consistent with Becker's prediction in the sense that less market concentration, that is higher level of competition, will generate lower discrimination against women, and this is because discriminators will be competed away from the market. So just to conclude, in this paper we show that gender discrimination in access to consumer credit markets exists, and it's quite large, at least for the case of Chile. We estimate that the efficiency costs associated to gender discrimination are on the order of $6 million per year, which means that banks are basically losing money because of gender discrimination. And note that our estimation of foregone profits is a lower bound, since we are only considering credits from borrowers between 25 and 35 years old. So as far as the effects are comparable for other age cohorts, then the efficiency costs at the population level are expected to be much larger. We also find that gender gaps on access to credit are likely driven by taste-based discrimination, especially on the part of male officers. We find that anti-discrimination information treatments are unlikely to be successful. Maybe we should try with different treatments oriented to directly reduce overconfidence bias. Also, I think it seems important to understand what's the role of culture on the development of this discriminatory behavior against women, and so on. Finally, we also find that in line with Becker's prediction, we show that increasing competition appears to be an effective way to reduce gender discrimination against women. Now, it is important to say that our evidence is focused mostly on discrimination in face-to-face relationship between banks and borrowers. Well, this is the way that most banks work around the world. Banks are increasingly adopting fintech technologies and machine learning techniques to automate the relationship with clients. So the question is whether these new technologies decrease or increase discrimination against women. Some researchers are already working on this question, and the evidence suggests that gender discrimination still persists behind the design of the algorithm. So that's bad news, and this is certainly a very interesting venue for future research on discrimination in credit markets, and I think the research community should definitely push more on that direction. Okay, I will stop here. Many thanks for watching. I hope you enjoyed the presentation. And of course, if you have any question or comment, please do not hesitate to send me an email. We will really appreciate your feedback.